Hello guys and welcome to our daily dose. Today is the 6th of October 2016. I first of all have to make a very important apology for the fact there haven't been any daily doses come out for the past more or less a week now. I do apologise. I have been a bit under the weather in the sense that I haven't been unable, I've been quite bedbound really, so I haven't had a chance to actually do these videos to the quality that I'd want to. But never mind, we got a lot that we can talk about today now, so that's quite important there. So what we're going to discuss today is a little bit about the blog post I've already done on our website, www.sanctuary.co.uk, and there's a blog post on there, the market update about the Great British Pound surpassing a 31-year low. Now, conversations happening with regards to Brexit believe that the likelihood is that the UK is going to leave the European Union in a shorter period than originally anticipated. Theresa May have stated that it's going to be by March 2017 we would have made significant advancements in the timeline in terms of what needs to be done for us to actually leave successfully. So the important thing to note here, and there's a blog post, please do check it out there. There's a link in the description below. But the important thing to note about this is, if we get the right page up, that lows are very, very interesting points. Lows mean, especially for 31 years, quite a long time. And if you stretch back even on something like TradingView, they're not going to have the data for 31 years. So you kind of got to, it's messy. You're looking at it, you pull it out a day, you pull it out a week, on these longer term charts, and it just doesn't look, you have nothing to gauge on terms of where to go. I'm looking back here until, okay, that's the October 2015. I know you can't, even if you go on the monthly there, it's kind of quite tricky to go all the way back, so to speak. You can go back a number of years, but it's quite messy and quite choppy there in terms of trying to find the right points. You just, kind of, does that make sense? But so you can see here I made this post based upon this point here on the 126.8 handle, which was a previous low set yesterday, and the market as we are trading today, it is now 2:05 UK time, so we're just before the US Open there, and the market has pushed down aggressively through that level. Now if this level holds, we'll look around, this is the original low that was surpassed here, which is on this 128.69 region. Market pushed down there this week. It's kind of hovered a bit, which kind of is just a pause. It's, are we going to have a retest early on? Are we going to, is the market just going to come back down? And indeed it has. And it's very, now the long-term players are going to come into the market. So if we can hold for, if we can hold on the weekly time frame, on a weekly candle below this 128.69, then of course we could look to see some quite good selling pressure there and a good short position to hold quite a long term. As for myself, I'm a technical trader, so I'm going to be looking for the market to come up around this 126 and try and see some price action that's going to start seeing the market round off a little bit, and we'd be entering short. It's one of those situations where not really interested in chasing the market. We don't really know what it's going to do today. In terms of, it's moving to the downside, yes, but we have got non-farms tomorrow, so that's an important point to play. So if we have a non-farm payroll which causes the market to push up here, so a weak US number causing the pound to strengthen, we could see that move towards the 128.69 a lot quicker than if non-farm wasn't happening tomorrow, so to speak. But we kind of see what the numbers doing tomorrow. We could just see a good number and the market just continue downwards. But this is a very interesting opportunity that a lot of people got involved with over the last week or so. And you can kind of see here the market kind of gap down a little bit upon the open, so it's one of those where it's gap down just right on the cusp of this support level, and broken down here on this support level, just gone through it really and just hadn't really stopped. So please do check out that blog post. It's not very long. It's not trying to actually go into all depth about it, but it's nice now. I'm going to try and upload a couple of these small little blog posts that kind of just talk a little bit, give a bit more information on the videos. I've noticed some of these videos when I look back, sometimes I'm running a bit short on time in terms of how I want to get across the information. I want it to be short, snappy, and engaging for you guys out there, but I don't want them to, to be having to make an hour-long video and you guys don't even want to watch, it's too long to watch or whatever, especially on every day. So having a quick, snappy little blog post that can kind of help a little bit in terms of getting the ideas down on paper. So that's an interesting opportunity, and there's not really much else to say about it, really. I mean, we've got non-farm tomorrow. There's no point second guessing what's going to happen. We kind of just read the price action, kind of see what's going to happen at 2:30 this afternoon. And the other one there, which the German 30 again. Now, the German 30 has always been a distinct favourite of mine in terms of trade. I like the way it does actually trade. So this is another messy little chart that is kind of, I don't know why, I'm cancelling my subscription to TradingView, I think, because it's just not that great, really. Basically, we've got this inverse head and shoulders pattern that we had here with the left shoulder, the head, and the right. It's kindly sloping. I said in a previous video, head and shoulders patterns do not have to be as as horizontal as people make out. They don't have to be as symmetrical. You can have multiple shoulders on each side. You can have a very, very elongated head, all these sorts of things. But the market, and we got in on this, made a very, very aggressive move to the upside, and it was a very, very good day for us. Of course, I believe it was a Friday that sort of situation was going on, and as a result, we weren't really comfortable holding a position over the weekend and so forth. So we got out that early at a good profit there. So we made our money and we got out. So that's a good thing. But if we go up to the higher time frames, we can kind of see that the market is being quite choppy now. It's, you can see by these candles is long wicks and intermediates, bit of green, bit of red. It's kind of ebbing and flowing. So it's one of these whereby you've got to kind of get your optimal timings in. It's kind of drifting, and I hate drifting markets. I find that I'm much better when there's actual movement in the market in terms of actually how to position myself. When the market just drifts a couple of prices here there, I just, no, that's not my sort of style of trading. Like this sort of area here is where for myself personally is I would despise to trade. That there would be horrific. It's literally moved 40 prices in gosh, what's that, 8-10 hours, and it's just moved 30-40 prices just ebbing and flowing, and it's one of those where you can be in a trade for like 3-4 hours and it hasn't even moved, and it's for a day trade. That's extremely frustrating. You can kind of see we had a bit of a breakout here, trying to break these highs here, unable to do so. Markets come back off. Could see a bit of selling pressure now. It's kind of this counterintuitive a little bit in the sense that if the pound continues to get slammed off, and bearing in mind, I'm looking at the German 30, but the German 30 and the UK 100, the FTSE index, they're going to have positive correlations, albeit they might not be 1 in terms of a correlation coefficient. But they're going to move opposite to another. So as the pound slams off and the pound becomes weaker, that gives an opportunity to overseas investors then who will see our domestic shares as being cheap. So they're going to come in and buy them. So you see this inverse relationship between the value of a currency and its share and its stock market. So you can kind of see here that the market's drifted up with a lot of candles here where it's not really making much headway, and then you've got 3 largish candles where it slams off. It's then made 3 candles where it's trying to make up, and it's still, even with 3 candles of green, it's still unable to make the high of this previous red candle was selling off. And you got this red candle. So I wouldn't be surprised if we start to see a bit of selling pressure going in here. So, and of course, correlations break down in the short term as well. Now, you might have, if you're a long-term investor, then of course you'll be paying attention to how the German and the FTSE indices are working in comparison to the actual, say, cable matrix. But then on the flip side, you don't want to be focusing on it too much intraday, because there's so many different amounts of news, there's so many different big players who are going to decide to come in on longer term frames, shorter term frames, and they're going to create noise and distort the market in that frame of mind, if you know what I mean. So it's gonna, those people, they might have a a 12-month view, so they get in this afternoon at say 3:30, whereas another player might only be looking at a 3 to 6 months time horizon and might get in at 10:30 this morning. It's one of those where the longer the time frame, the intraday time that you actually get in terms of your price doesn't matter as much. It's quite negligible, so that can add a bit of noise and distortion to how the correlations are if you've got a lot of selling pressure from one large fund manager or one large asset manager there. So you've got the important thing to see here. You've got these highs here, the market's come up, it's bounced off them, it's tried to come up a little bit again. Obviously you see how this candle closes here. Essentially the market's trying to peep up. The green candles going up are, they're losing momentum compared to the aggressive selling. We've got it again here. The market's coming up, forming the original high, and you've got these aggressive selling off candles. So you can see we've got a bit of a range here with a little bit of a, it's only very rough, guys, because obviously there's quite a bit of a tolerance here. So you can kind of, if you draw a line roughly around there, you can kind of see that you're getting a couple of these wicks in. So really, it's just ebbing and flowing. You kind of don't want to see much until you get down to this 503, really, or below. It's kind of quite choppy. It's not really giving you much. If you go on the higher time frames there, you can kind of see that the market has pushed up quite high, and you've got these long wicks that we've already spoken to. Now, I'm a big fan of long wicks. I find that the long wicks actually give you an opportunity. People get scared people get scared to get into an opportunity because it's so close to a breakout. The majority of breakouts fail, and if you're right and you're getting right on the cusp of when everyone's scared I'm not gonna get in yet, so to speak. Go with the probabilities. You are going to lose some trades. If, for example, if I was up here now and I was right at these long wicks, I would take a short on, because my stop is just going to be a little bit above, so to speak. It's going to be quite a low, 20, 30 pips you might lose, for example. But then the downside is that you could have it coming right the way down to this 10,500, this kind of area around the top of this candle here. So it's a good trade. And of course, you might lose a couple of pips there, but you've got two long wicks already showing price rejection, so that can be a good way of getting in. People tend to see it going up higher by here, and then they'll start buying it. But then the wicks give you a clue. If you've got solid candles, then maybe you might be thinking, it's retesting. But it's one of those things. You've got to focus on your own strategy. So that's basically it for today. It's, very basic overview of what's really happening. I mean, non-farm payroll tomorrow is going to give us a clear indication of where the market's heading. As I said, this inverse head and shoulders pattern was an excellent pattern that was spotted later on last week. But it's kind of just keep looking. I mean, you haven't got solid candles. You've got large traded ranges where the market's not really going anywhere. It's since the beginning of October, it's moved about 100 pips to the highs and lows, and it's kind of it's ranging. It is ranging. So if you could put a resistance level up here and just kind of trade in and out of that, see if you can make a bit of money there. But so join us in tomorrow, guys, and please do make sure you check out our market update blog there. There's a couple of other blog posts, and I will be posting another one this evening, if not tomorrow morning. Please do have a quick look there, and if you have any queries, please don't hesitate to contact us via the contact us logo here on our website. There's a description below where we put all the links as well. So thank you very much for your time, guys, and see you tomorrow. Good luck.